Hello everyone, very good evening all of you. Today let us start with investment decisions. So this is one of the most important areas from exam point of view. And also when you look at corporate finance at any level, this capital budgeting decisions or which are popularly known as investment appraisals or investment decisions play a very big role. So theoretically it is important and also practically it is very important. This is one of the chapters with highest weightage in CA intermediate. So please be very careful. Okay. So investment decisions, as I told you, is also known as capital budgeting or investment appraisals. Okay. Now, before starting, I will ask you a quick question. In the chat box, please respond. How many decisions financial management deal with and what are they? How many decisions financial management deal with and what are they? Anu is saying 3, very good, correct. Ambika 3, correct. Anjana 3, correct. Muhammad 3, correct. And what are they? What are they? I want you to tell 1, 2, 3. What is 1? What is 2? What is 3? Okay. First one is financing decisions. Second one is investing decisions. Third one is dividend decisions. Excellent. So first one is financing decisions. Second one is investing decisions. Third one is financing decisions. Okay. So what is the purpose or meaning of these financing decisions? How they use, how they are useful for a company? This is to mobilize required capital. So financing decisions are used to mobilize required capital. So cost of capital, capital structure theories, leverage analysis are the chapters involved in financing decisions. Investment decisions to utilize the available funds. Okay, so here minimize cost of capital and achieve optimum value or optimum capital structure is the primary objective of these decisions. While making financing decisions, the CF of the company, he always looks to achieve optimum value for the firm, optimum capital structure for the firm, best gearing, best leverage, and how can we minimize the cost? These are the objectives. When you are looking at investment decisions, the objective of the CFO is to maximize the returns on investment, maximize the shareholder wealth, maximize the firm's value. These are the objectives. What are the objectives? Maximize the returns on investment, maximize the shareholder wealth, maximize the firm's value. These are the objectives when you are dealing with investment decisions. What are the chapters involved in investment decisions? Capital budgeting, which is also known as investment decision making. Okay. Risk analysis in capital budgeting. Risk analysis in capital budgeting. Working capital. Working capital. Working capital is also, working capital is kind of hybrid decision. It involves both the aspects of investing decisions, financing decisions. But rather, I say at CA intermediate level, it is about 80% of working capital is about investing, whereas 20% is about financing, maybe 10%, 20% is about financing. Okay, this is investment decisions, and this we are going to discuss at length today. Now, can someone tell me what is the meaning of dividend decisions? What is the objective of dividend decisions? So, what is the objective of CFO when he is making any dividend decision? To ensure that shareholders are happy with dividends and growth plans. There are two aspects. Today's dividend is important for me. Tomorrow's growth is also important for me. To ensure that the firm has adequate capital to finance investment opportunities, to ensure that shareholders are happy with the dividends and growth plans of the company, and also to ensure that adequate cash is available, capital is available, funds are available. That is the main intention of making dividend decisions. So basically, how much of the earnings is to be distributed as dividends, how much of the earnings are to be retained. So this is about dividend decisions. Here, we study dividend policies and cost of capital and value of firm. Cost of capital and value of firm also in some way connected to dividend decisions. So these are three decisions. So this is a brief introduction to three decisions taken by finance managers. Now let us go to investment decisions. So we call it investment appraisal. For investment appraisal, we use certain capital budgeting techniques. We use certain capital budgeting techniques. So write down capital budgeting techniques. From there, 2 arrow marks down. Capital budgeting techniques. Capital budgeting techniques. From that, 2 arrow marks down. Capital budgeting techniques. From that, 2 arrow marks down. Capital budgeting techniques. From that, 2 arrow marks down. Okay. On the left hand side, write down traditional techniques. Left side, traditional techniques. So we already know that this OneNote will trouble us. That is the reason we have one Excel sheet also. We have one Word sheet also. Word document also. See, again, it is revolving. Hello, Goya. So go to shapes and here 2 arrow marks down. Tadan, tadan, tadan. Now tell me, left side, what are we supposed to write? Hello, I want your answer in the chat box. What are 2 types of decisions? Tadan. Here we write traditional techniques. Here we write modern techniques. Modern techniques are also known as DCF. Discounted cash flow techniques. Discounted cash flow techniques. Okay. So here we write traditional. Here we write discounted cash flow techniques. Can you tell me how many traditional techniques are there? One is payback period. Second one is accounting rate of return, ARR. Payback period and ARR. And coming to discounted cash flow techniques, we have so many important techniques. One is NPV, net present value. Second one is profitability index. Third one is IRR. Fourth one is the discounted payback period. Discounted payback period. Fifth one is MIRR. IRR and MIRR, many students are confused. Many students feel they are very difficult, but trust me, they are very, very, very simple basics. Basics. Okay, I'll take you through. So just copy this chart. There are certain traditional techniques like payback period and accounting rate of return. And there are certain discounted cash flow techniques, which are also known as modern techniques, and that consists of net present value NPV, profitability index, which is also known as desirability factor or NPV index. Profitability index is also known as NPV index or desirability factor. Then we have IRR, internal rate of return. Then we have discounted payback period. Then we have MIRR. Okay, modified internal rate of return. So these are the techniques. Okay, before that, tell me, when it comes to capital budgeting or financial management, what is more important? Profits are important or cash flows are important? You tell me which one is more important. So capital budgeting is based on, what do you think? Capital budgeting is based on cash flows or capital budgeting is based on profits? You tell me in chat box. What do you think is the more important thing? Hello, I'm looking for your answer. Cash flows. Very good. Excellent. Cash flow. CF. Cash flow. Excellent. Cash flows. Now, can you tell me what is the relationship between profits and cash flows? Can I say CFAT, cash flow after tax? CFAT means cash flow after tax. Can I say CFAT is equal to PAT, profit after tax, plus depreciation? This is the equation. Cash flow after tax is equal to profits after tax plus depreciation. Depreciation is non-cash moving item. So can I ask one question? Depreciation. Whether depreciation is a cash moving item or a non-cash item. Okay, you tell me whether depreciation is a cash item or non-cash item. Non-cash item. Very good. Excellent. This is basic. Everybody is giving correct answer. Okay. Whether depreciation is an operating item, like operating cost item, or non-operating item. Whether depreciation is an operating cost item or non-operating cost item. Okay. Please, I want your answers in the chat box. I'm so happy everybody is saying operating. Anu, no, it is non-operating. It is operating cost. Depreciation is operating cost. It is not non-operating cost. As far as CA intermediate is concerned, non-operating costs are only two. There are only two types of non-operating costs. Can someone tell me what are non-operating costs as far as CA intermediate is concerned? There are only two non-operating costs. One is, no, someone is selling and distribution. Someone is telling selling and distribution. No, my dear friend, selling and distribution is also operating cost. Selling and distribution is also operating cost. Non-operating costs, there are two non-operating costs. One is interest, because interest is finance cost. Second one is profits. Sorry, tax on profits. Like income tax. So these are non-operating costs. Interest is non-operating cost, tax is non-operating cost. So depreciation is operating cost, my dear friend. Depreciation is operating cost. Now the question is, how do we calculate cash flows? So first and foremost important thing you need to see in the examination is, in the question, whatever they have given, first you need to read and understand whether they have given cash flows or profits. In capital budgeting question, what you need to do? First, you need to check whether the numbers given in the question are profits or cash flows. If it is cash flow, straight you can solve the question. But if it is profits, first you need to make a working notes for cash flow. Okay, so it will be like this. Particulars rupees. So first take sales, from that less variable cost. So can someone help me? If you subtract variable cost from sales, what will you get? Contribution, right? From that less fixed cost, what will you get? Okay. From that less fixed cost, what will you get? Everybody is saying profit. Is it gross profit or net profit? This one is gross profit or net profit. Which one you think? Everybody is saying profit. Profit kya hai bhai? Gross profit or net profit? Gross. Everybody is saying gross profit. You are grossly wrong, idiots. This is not gross profit. ये gross profit नहीं है. This is not gross profit. This is not net profit also. This is called operating profit. This is called operating profit. And what is the nickname for operating profit? EBIT. Nickname for operating profit is EBIT. From EBIT, less interest. So Up to this, you subtracted operating costs. Now you are subtracting non-operating costs. Up to this, you subtracted operating costs. Now you are subtracting non-operating costs. So less interest. Okay. What will you get? EBT, profit before tax. Profit before tax, less tax at a given rate. Less tax at a given rate. What will you get? Profit after tax. This profit after tax is also known as, profits after tax is also known as net profit. Net profit. You understand? So after calculating profits after tax, add back depreciation. Then you will get CFAT. So what is CFAT? Cash flows after tax. This is what we use in capital budgeting. Sometimes, because depreciation plays a very big role in capital budgeting, depreciation plays a very big role in capital budgeting. Here, what we do, sometimes we take profits before depreciation and tax. Sometimes we take profit before depreciation and tax, PBDT, profit before depreciation and tax. From that, we subtract depreciation. Then we get profit before tax. Then we subtract tax. Then we get profit after tax. Then we add back depreciation. Then we get CFAT. Okay, sometimes we follow this pro forma because depreciation plays a dominant role in capital budget. Simple. If someone asks you, hey, in capital budgeting, we use cash flows. Depreciation is a non-cash moving item, but why are you considering depreciation as an important element in capital budgeting? So I told you, in capital budgeting, we consider cash flows. Correct? Do you agree? Depreciation is a non-cash item. Then why do you consider depreciation in capital budgeting? Ta-da! Can someone answer this? In capital budgeting, we consider cash flows. Depreciation is a non-cash item. Then why do you consider depreciation as an important element in capital budgeting? Excellent. This is because of tax purpose. Depreciation has tax benefit. So, considering depreciation gives tax advantage to firm. That means when you consider depreciation, tax amount comes down, which will result in increase in cash flow after tax. That's why depreciation is important. When you consider depreciation, tax amount comes down. So automatically, your cash flows will increase. This is point number one. Point number two. We discussed about payback period, ARR, NPV, then profitability index, then IRR, then discounted payback period, then MIRR. So many techniques are there. Out of all these techniques, only in one technique we use profits after tax. In all these techniques, we use CFAT, except in case of one technique. Which one is it? You tell me. Which one is it? You tell me. Important, very, very, very important. ARR. In ARR, we use profits after tax, but not the CFAT. Why? Because it is not finance technique, it is accounting technique. ARR is borrowed from accounting rate of return. ARR is a ratio calculated based on accounting profits. So the name itself says accounting. So ARR is telling by my accounting who, my finance nahi who. So that is the reason we consider PAT in ARR, but in all the other techniques, we consider cash flows. Okay. So guys, please tell me, do you understand these performance? How to calculate cash flows? Do you understand? Hello, hello, hello. Fast, 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 fast. So shall we solve a problem on this? This is your beautiful ICI material. So I'm going to illustration 1. I'm going to illustration 1. Illustration 1. So this is what they are saying: capital budgeting techniques, traditional techniques which do not consider time value of money, time adjusted or discounted cash flow techniques, and payback period, ARR, NPV, profitability index. This is what just now we have written at the beginning of the class, and then we'll see what it is. Okay. So can I have someone who can help me reading this problem? Can someone help me with reading this problem? Alina Joy, can you read this problem, please?
Yes, sir.
Hi, Alina. How are you?
Fine.
Yes. Please read this question, ma.
ABC Limited is evaluating the purchase of a new machinery with a depreciable base of rupees 1 lakh,
Okay.
expected economic life of 4 years, and change in earnings before taxes and depreciation of rupees 45,000 in year 1, rupees 30,000 in year 2, rupees 25,000 in year 3, and rupees 35,000 in year 4. Assume straight line depreciation and a 20% tax rate. You are required to compute relevant cash flows.
So can you tell me what is the value, book value of the asset, cost of the asset today? 1 lakh. What is the expected economic life? 4 years. So guys, can you tell me what is depreciation per annum? So put the heading illustration 1. Working notes. And remember, it is very, very, very important to write working notes, even if it is a very small calculation also. Otherwise, you lose marks, because in many in many questions in ICI exams, they will ask you working should form part of your answer. So we'll write depreciable base of the asset. Depreciable base of the asset is nothing but today's WDV. So it is 1 lakh. Economic life, 4 years. So guys, can you tell me depreciation? Hello, I want answer. Depreciation, how much? 25,000. Very good. Per annum depreciation is 25,000. Okay. So there are 4 years. Okay. So they are telling profits before taxes and depreciation is given in the question. Calculation of CFAT. Particulars, year 1, year 2, year 3, year 4. Okay. In that we write profit before depreciation and tax, which is given in the question. Profit before tax and depreciation is given in the question. 45, 30, 25, 45,000, 30,000, 25,000, 45, 30, 25, and 35. Okay. Now tell me, what are we supposed to do? Less depreciation. 25,000. We'll take depreciation 25,000 for all the years because it is straight line method. It is not WDV, it is straight line method. So we have considered 25,000 every year. Then profit before tax. 45 minus 25. 25, 0, 10,000. Then tax. I think tax is given as 20%. Can you please confirm what is the tax rate? Guys, please confirm what is the tax rate? 20. Very good. Very good. So apply 20% on this. It is 4,000, 1,000, 0, 20,000. Profit after tax. Profit after tax. What is the error they are showing? Ignore karo. Chalo. Anyway, profits after tax. Now add back depreciation. Add back depreciation. Ta-da. So can someone tell me cash flows CFAT? Hello, tell me cash flows. First year, how much? 41. Very good. Correct. Second year, 29,000. Very good. Third year, very good. Excellent. I'm so happy you are participating. You are calculating 33. Very good. This is CFAT, and this is the end of our question number 1. So did we get the same answer? ICI got 41, 29, 25, 33. 41, 29, 25, 33. Yes. Okay. So let us go to next question. Next question might be probably on payback period or ARR. We'll see. Question number illustration 2. Yes. So they're asking determine average rate of return. Okay. Very good. So can someone read this question, please? And Anna, can you read this question, please? Who wants to read? Hello. I have Anjana Sri Kumar. Can you read the question, ma? Anjana?
Yes, sir.
Yes, read this, please.
A project requiring an investment of rupees 10 lakh and it yields profit after tax and depreciation, which is as follows. Years profit after tax and depreciation. First year 50,000, second year 75,000, third year 1,25,000, fourth year 1,30,000, fifth year 80,000. Suppose further that at the end of the fifth year, the plant and machinery of the project can be sold for rupees 80,000. Determine average rate of return.
Okay. So now what are the numbers given? Are they cash flows or profits? They are profits after tax and depreciation. That means PAT. So to calculate ARR, what do we need? PAT only. So they have already given PAT. Isn't it? Straight can we take? Yes. So can you tell me what is average PAT? Total PAT is 4,60,000 divided by 5 will give you average PAT. Can you tell me what is average PAT? 92K. Correct. So write down ARR is equal to average profits after tax divided by investment into 100. This investment is there, no? This can be initial investment or this can be net investment or this can be average investment. So you can calculate ARR based on initial investment or you can calculate ARR based on net investment. You can calculate ARR based on average investment. What is initial investment given in the question? 10 lakhs. What is net investment? Initial investment minus salvage value. Minus salvage value. If you subtract salvage value from initial investment, you will get net investment. So 10 lakhs is your initial investment. 80,000 is the salvage value. So net investment, can I say, is 9,20,000? Guys, do you understand how net investment 9,20,000 came? Everybody, please respond. Do you understand 9,20,000? Very good. Average investment is initial investment plus salvage value divided by 2. Why? Initial investment is the opening WDV of the asset. Salvage value is the closing WDV of the asset. At the end of the life, what is the WDV of the asset? Salvage value. So what is average investment? Initial investment plus salvage value by 2. So initial investment 10 lakhs plus salvage value 80,000 divided by 2. So can I say it is 10 lakh 80,000 divided by 2, which is 5 lakhs 40,000. How many of you understand 5 lakhs 40,000? Initial investment 10 lakhs. Salvage value 80,000. Average investment is 10 lakhs plus 80,000 divided by 2. That is 5 lakhs 40,000. Correct? So this average investment can also be calculated with another formula. Okay. What they do, you know, half of initial investment. Okay. Half of initial investment minus salvage value plus salvage value. Half of initial investment minus salvage value plus salvage value. So this will become half of 10 lakhs minus 80,000. In the exam, you are not supposed to write 10L minus 80K. No, you have to write 10, 00, 000. For the purpose of classroom, I'm using this kind of, you know, short forms plus 80K. So now calculate 10 lakhs minus 80 is 920. 920 into half. How much? 9,20,000 into half. Can you please tell me how much? 920 into half must be 460. So this is 460 plus 80,000. This gives you 5 lakhs 40,000. Correct? So this is one way of calculating, or opening investment plus salvage value divided by 2. Both will give you same answer. Okay. But in ICI textbook, they follow this. In ICI textbook, they follow this. But you can do it in any way. So guys, do you understand? ARR can be calculated in 3 ways. Using initial investment, using net investment, using average investment. Initial investment in this question is 10 lakhs. Net investment in this question is 9 lakhs 20,000. Average investment in this question is 5 lakhs 40,000. Average PAT, which is numerator, which already you calculated and told me 92,000, remains the same. So one way of calculating ARR is 92,000 divided by 10 lakhs into 100. Second way of calculating it is 92,000 divided by 9,20,000 into 100. Numerator is same, denominator is changing. This is 92,000 divided by 5,40,000 into 100. Can you please tell me what are the answers? Guys, in the chat box, please tell me what are the answers. Excellent. Excellent. First one is 9.2%. Next one is 10%. Next one is 17.04%. 17.03 or 04. 04 is more appropriate, but even if you rate 17.03, it is still fine. That's all. So are we done with question number 2? Can we move on? Can we move on to next question? Very good. Question number 3. So who's gonna read question number 3 for me? Sandra Chandrahasan, can you read?
Yes, sir.
Hi, Sandra. How are you?
Fine, sir.
Good. Read.
Okay. Compute the net present value for a project with a net investment of 1 lakh and net cash flows for 1 year is 55,000. For year 2 is 80,000 and for year 3 is 15,000. Further, the company's cost of capital is 10%. PVYF at 10% for 3 years are 0.909, 0.826 and 0.751.
Super. That's all. Simple question. Okay. So shall we do it? Shall we do it? So put the heading. Question number 3. Illustration number 3. Calculation of NPV. calculation of NPV. So they have already given cash flows, isn't it? They have already given net cash flow. So we don't need to do anything. So they have given cash flows. So we take year 1, 2, 3, 4, 5. I don't know how many years it is. Only 3 years. So 4 is not required. 5 is not required. Then we take cash flows. Okay. 55, 80, 15. 55, 80, 15. So discount factor at a rate of 10%. Now, one examination tip. If they have given discount factors in the question, take whatever they have given. Don't calculate with your calculator. Why? Because if you calculate with calculator, it gives you a big number, then you will have to round it off to 2 digits or 3 digits or 4 digits. There might be minute differences. If you need to calculate with calculator, when in question it is not given, then you round it off to 3 digits. After a decimal, 3 digits. Okay, but if it is given in the question, we'll take whatever it is. 0.909, 0.826, 0.751. Is it what they have given? Yes. So we'll take discounted cash flows, which is cash flow multiplied by discount factor. These are known as present value of cash inflows. So we'll add all these things from that less initial investment, or you can also write as present value of cash outflow, which is 1 lakh. Subtract this and you will get net present value. I do not know numbers. You have to tell me what it is. Net present value. Hello. Oh my God, I'm getting answers already. 27,340, 27,340, 27,340. Everybody is doing, I don't know. This is, tadan, this is, this minus this, very good. This is the answer. Net present value, 27,340, correct. Okay, now, decision-making rule. You tell me, from the point of view of NPV, when will you accept project? When will you accept a project? If NPV is positive, correct? Okay, we'll prepare a table. Okay, we'll prepare a summary table. So write down like this. Technique. In case of single project, in case of multiple projects. So we'll write a decision-making rule. Tadan, tadan, tadan. In case of single project, what will you do? In case of multiple projects, what will you do? Okay, first technique, I write payback period because I'm giving you the overall picture. Payback period. In case of a single project, accept the project if actual payback period is less than the targeted payback period. The target payback period is less than the target payback period. What is target payback period? Now you are investor. You want to invest money in a project. You are investor. You want to invest money in a project. In your mind, you thought, okay, I can invest 10 lakhs now, but I want money in 4 years. That is your estimated or target payback period. Now, if there is a project which gives your money back in 3.5 years, you want money within 4 years, there is a project which gives you money in 3.5 years. Will you accept the project? The answer is yes, because the payback period of the project is 3.5. But your target payback period is 4 years. Within 4 years, if it is coming, welcome. Otherwise, no. If not, reject the project. Now, I don't know. You tell me, in case of multiple projects, what will you do? You have 3 projects, project A, project B, project C. You calculated payback period. Which one you choose? Will you choose the project with lowest payback period or the project with the highest payback period? What you gonna do? You tell me. One is telling lowest payback period, lowest. Very good. In case of multiple projects, accept the project with the lowest payback period. Why? Since early recovery of capital is good. Early recovery of capital is good. I'm getting money faster, so I'm happy. This is payback period. Now, ARR. ARR. In case of a single project, accept the project if the actual ARR is higher than the required rate of return. If not, reject the project. Accept the project if the actual ARR is higher than the required rate of return. If not, reject the project. Correct? Now you tell me, in case of multiple projects, will you choose the project with highest ARR or lowest ARR? Highest or lowest? Muskan is asking, can you please scroll up once? Yes, madam. Highest. Very good. Correct. Right now. Right now. In case of multiple projects, accept the project with highest ARR, because ARR is like profit. Your return. Higher the return, happier I am. Since higher returns are good. Higher returns are good. Okay, next, NPV. In case of a single project, accept the project if NPV is positive, reject if NPV is negative. Accept the project if NPV is positive, reject if NPV is negative. If NPV is negative, I don't want you, sorry. If NPV is 0, if NPV is 0, that is called IRR. If NPV is 0, no, someone is saying accept. See, you may accept or you may reject, but if NPV is 0, the discount rate is IRR, isn't it? You may accept the project. Okay, now here, what will you do? In case of multiple projects, accept the project with highest NPV or lowest NPV? Highest NPV. That's all. Why? Because highest NPV maximizes shareholder value. Highest NPV maximizes shareholder value. Profitability index. Can someone tell me, when will you accept the project based on profitability index? Accept the project if profitability index is higher than 1. Reject if it is lower than 1. Accept the project if profitability index is higher than 1. Reject the project if it is lower than 1. Correct? Now, in case of multiple projects, accept the project with highest profitability index. Higher index gives higher cash inflows. Higher index means higher present value of cash inflow, which is good. Now, a question for you. When will you use profitability index for decision making? Tell me. When will you use profitability index for decision making? There is a situation, special cases, bolke. In ICI material, they have given special cases. So, under what situation, in which circumstance you use profitability index for decision making? Hello, come on, please. In capital rationing, investment decisions are based on profitability index, but not on NPV or IRR. In capital rationing situation, investments are based on profitability index. What is capital rationing? Capital rationing is a situation where you have more profitable investments, but less amount to invest. Like you have 4 projects, all the 4 are profitable. But to accept all the 4 projects, you need to have 1 crore in hand, but you have only 45 lakhs in hand, for example. That is the situation which we call capital rationing. So capital rationing is a situation where the amounts available for investments are lesser than how much of the investment you need to accept all profitable projects. In capital rationing situation, decisions are made based on profitability index. Okay, next, IRR. Accept the project if IRR is higher than the cost of capital. IRR is higher than cost of capital. IRR is greater than KO. Accept the project. IRR is greater than KO. Accept the project. IRR should be higher than cost of capital. If not, reject. If not, reject. If IRR is exactly equal to KO, what happens? NPV will become 0. Okay, now you tell me, in case of multiple projects, what will you do? Accept the project with, hello, highest IRR or lowest IRR? What do you think? Highest IRR or lowest IRR? High. Because IRR is also return on investment. Highest return on investment you will accept. Highest return on investment you will accept. Okay. Now, what is the next one? In case of multiple projects, accept the project with highest IRR. Accept the project with highest IRR. Okay. Then discounted payback period. Simple. No need to write anything. Same as payback period. Payback period, discounted payback period, there is no difference. Payback period is calculated with normal cash flows. Discounted payback period is calculated with the discounted cash flows. That's all. So, guys, do you understand this decision-making rule? This decision-making rules, I have given wholesale for all the techniques put together. Whether there is single project or whether there are multiple projects in the question, I have given you one matrix which will help you. In case of PI, if it is equal to 1, then we reject it. Need not be. Muskan is asking, in case of profitability index is 1, then we reject. See, profitability index is equal to 1. NPV equal to 0. IRR equal to KO. All these are same. All these are same. When it happens, this happens when present value of cash inflows are equal to present value of cash outflows. Okay, now how will you calculate PI? Present value of cash inflows divided by present value of cash outflows. So PI is 1 means present value of cash inflows divided by present value of cash outflows is equal to 1. What is the meaning of it? By way of cross multiplication, present value of cash inflows is equal to present value of cash outflow. Point number 1. Point number 2. What is NPV? Present value of cash inflow minus present value of cash outflow. When it will become 0? When present value of inflow is equal to present value of outflow. So technically all these 3 things are same. So in this situation, yes, you may accept the project. You may accept the project. Because it is giving you your cost of capital, which is the minimum rate of return you want. Like you can say that it is one kind of break-even point. So you achieved break-even point. That means you recovered cost. No, profits are not there, but it is not a loss-making deal. So sometimes prestigious projects will be there. Say, for example, Reliance Industries is doing one prestigious project in Ahmedabad. Say, for example, a real estate project, which involves some, say, 5,000 crores or 10,000 crores, but which is of some significance to the economy or some prestige or some growth or something boosting industrialization. So you thought, I will do this project, even if it gives 0 NPV also. But maybe if it is negative, you might not be able to do that because it is a commercial project. Sometimes if it is 0 also, you'll do. Personally, if NPV is 0, I will not do the project. In exceptional cases, we can do. So is that clear? Is that clear, guys? You understand this table, you understand the meaning, you understand the decision-making rule. If you understand, say yes, then we'll go to next question. If you understand, say yes, then we'll go to next question. Okay, very good, very good. Excellent. Excellent. We'll go to next question. Question number 4. Visalakshi, can you read question number 4? So who is going to read question number 4? Wait, VIS. Read more. You can unmute and you can read. You are not audible?
Sir, am I audible?
Yes.
ABC
Who's that?
Limited. That's my nephew.
Very good. Read.
ABC Limited is a small company that is currently analyzing capital expenditure proposals for the purchase of equipment. The company uses the net present value technique to evaluate projects. The capital budget is limited to 5 lakhs, which ABC Limited believes is the maximum capital it can raise. The initial investment and projected net cash flows for each project are shown below. The cost of capital of ABC Limited is 12%. You are required to compute the NPV of the different projects. Project A, Project B, Project C, and Project D. Initial investment 2 lakhs for Project A, 1,90,000 for Project B, 2,50,000 for Project C, and 2,10,000 for Project D. Project cash inflows year 1, 2, 3, 4, 5. 50,000 each for Project A, 40,000 for Project B in year 1, 50,000 for Project B in year 2, 70 in year 3, 75 in year 4 and 75 in year 5. Project C, 75 for first and second year, third year 60,000, fourth year 80, and fifth year 1 lakh. Project B, 75 in first and second year, third year 60, fourth year 40, and fifth year 20.
Okay, now tell me one thing. What will you do if this sentence is not given in the question? You are required to compute NPV of different projects. So they asked you, hey, calculate NPV and tell us which project can be accepted. Now, in some questions, what they do, they will not ask you do this. They will just ask you, these are 4 projects under consideration. Which project should be accepted? Advise the company. Even then, if nothing is given, normally decisions are based on NPV. Normally, decisions are based on NPV. So, shall we do this question? Project A, B, C, D, 4 projects. Shall we do it? Okay, put the heading. Put the heading. Problem number 4. Calculation of NPV. Problem number 4. My system is asking, I am hungry. Can you put charge? Yes, we'll put you in charging. We have charger. Ta-da. Put the heading illustration 4. Illustration 4. Calculation of NPV of 4 projects. Particulars, project A, B, C, D. Particulars, project A, B, C, D. Okay. So we'll write initial investment. Under particulars, we write year. Under that, we can write 0, 1, 2, 3, 4, 5. What is the meaning of 0? 0 means we are writing cash outflow. Okay. So what we do is, we'll do simultaneously for all. So what we do is, please follow me. Okay. Please follow me. Wait 1 second. I'll tell you the pro forma. Here we write discount factor at 12% we write. Then we write ABCD, 1 minute, cash flow, discounted cash flow. Okay. So for A, we write cash flow, discounted cash flow. Okay. Just give me 1 second. Let me write pro forma, then you can copy. Then you can copy A, B, C, D. इसको हम बोलते हैं D, C, D. Okay, like this we do. Okay, because this is going to be a big table. One small suggestion could be, instead of writing in rupees, you can write in thousands. You can write here rupees in thousands. Rupees in thousands. Okay, so can someone tell me at 12%, what are the discount factors? Take calculator. Here, what is the discount factor I need to write? Make it fast, please. What is the discount factor I need to write? Excellent. I'm so happy someone said 1. Excellent. Always for 0th year, it is 1. Okay. Next, 1 divided by, how do we calculate? We calculate it like 1 divided by 1 plus interest whole power n, which is 1 divided by 1 plus interest is 12 given in the question. So we can write 0.12. 1 divided by 1.12 to power 1. 1 divided by 1.12, 0.893. Okay, 0.893. Next, just press is equal to, you will get next number also. Next year. .797. Okay, 0.797. Next year. 712. 0.712. Next year. Very good. Someone has given all. Jimmy has given all in one go. Okay. 712. After 712, 635, 0.635. Okay. Last year. .635 last year. Is it 0.567? Someone is saying 0.567. Okay. So for for project A, what is the outflow? For project A, outflow 200. So I'll put minus 200. Okay. 50 every year. 50, 50, 50. Okay. Discounted cash flow means take cash flow, multiply with the discount factor. Take cash flow, multiply with the discount factor. Is equal to sum of. This is NPV. I have already subtracted outflow also. 200 is already subtracted. I don't need to write present value of cash inflow minus investment. That is equal to NPV. I have already done that in first line. So NPV 19.8. Is it right? NPV 19.8. It is right. So can you do question number B and C and D for me? I want number here. And I want a number here. And I want a number here. Can you do it for me? Hello. Okay. So guys, we'll do one thing. I'll take a 5 minutes break. I'll take a 5 minutes break. No break for you. I will bring water. Water is over. In this 5 minutes, you are supposed to calculate this 3. Can you do that for me? Hello, hello. Say yes. Okay. Very good. Very good. Same meeting continues.